Listen, hopefully all is well with everybody. My name is Malcolm Lewis, senior accountant here with the Best Way Tax and Accounting. We're located in Metro Atlanta, in the city called Austell. That's where Six Flags Over Georgia is, and we're delighted to come to you today. We're starting to host a series of lunch and learns. Part of what we do is just giving back to make sure literacy is in place with every taxpayer, business owner. And so we want to make sure that we start a series of conversations. So much is evolving in the tax world. Again, I do salute everybody who's already on, those who are coming in today. Thank you for making whatever sacrifice you're making to get the information. I believe information makes the difference to set us up in a place of advantage. Again, my name is Malcolm Lewis. I am the senior accountant here at Best Way Tax Accounting Service. We do have a staff of accountants as well as other accountants who focus more on like tax planning, different strategies, bookkeeping, payroll, things of that nature. The specific conversation I want to have today is in the spectrum of tax preparation as relates to businesses. Most of what I'm going to talk to today, you can leverage it from a standpoint of small businesses, medium businesses, some significant larger business, nonprofits, things of that nature. You'll find a lot of different synergies. Again, we've been in this space. Now this company has been going for about 31 years. I've been actually doing taxes and in that realm for about 4 years before that, working at different companies. But this company has been going for 31 years. We've serviced clients throughout the continental United States and abroad. And we're very excited about doing it. I'm very passionate about taxes because I believe taxes is one road to helping us achieve different things as far as decreasing our monies that we're paying out in taxes to reposition those funds to do other things such as back into your business, back into financial products to really make a difference for your family and maybe even to create legacy. It starts with taxation. Ronald Reagan said this years ago when he was the president, he said the greatest threat to wealth is taxation. So I do want to talk about that. I'm pretty sure that many people on this call is probably going to be existing business owners or maybe have an aspiration to be business owners. I like that because of the fact the tax code was not written for actually the personal filers, individual taxpayers. The tax code was really written for business owners. So when you have a business, it actually puts you in a position to be able to do more creative things, be able to reduce your tax liability and what you're paying out by way of your business or your household. So the tax code again was written for tax for business owners, and so a lot of times when there's a drag on your revenue from different places on the individual side, especially if you're working, people who are working is known because of the fact the tax code was really not written for that individual. But business owners, the world opens up to the business owners. But you have to understand the code. You have to be able to use the code and be able to leverage off of the code. We've served people, companies as big as the city of Atlanta. We're as down to the sole proprietor with the small company, maybe a event planner, things of that nature. We've seen it all. We've done it all. And one of the things I'm going to try to do today, I got a lot of information. I'm going to be honest with you. I know we have an hour, probably less than an hour now. So I'm going to do most of this as quick as I can, but I don't want to do it too quick where I lose the value in what we're trying to do today. If I have to do a part two on this section, I will. But the thing today is to really position you to have a successful tax season for 2026 tax year, which you're filing for 2025. I do want to say this. One of the biggest sweeping tax legislations was just passed in July of 2025 by the Trump administration, called the One Big Beautiful Bill. There was a lot of different things in that bill that benefits business owners. There's a lot of things that was already existing that actually benefit business owners. Some of the things you may have not even known it actually existed. A lot of times when clients come to us, one thing we ask them to do is bring your last 2 years of business taxes. We ask that because we want to do a complimentary review to make sure that they were able to maximize and capitalize on many of the different deductions that they should have been taking. One thing we find out around 25% of the individuals or business owners, when we look at these tax returns, we have to go back and do amendments for them because of the fact many things were left off that really should have been able to put that individual in a very more favorable tax position. So the first thing I'm going to do is talk about the preparation of taxes. Okay, it doesn't matter what business structure you are. Some of these things are going to be just common to every business structure that you may have, whether you're S-Corp, C-Corp, partnership, nonprofit, you're filing a 990. Some of these things are just going to be common. So I want to kind of talk about that first of all. I got a lot of different information here, I'm going to be honest, which is all relevant to today, but I'm going to start out at least with that. Items needed for taxes. This is where it all starts. Items that are needed for taxes. I'm trying to get my talking points here. Give me 1 second. All right. Hold on. This right here. This here. All right, very good. All right, so preparation for taxes, items needed. This is where it starts, okay? Knowing what information that you need in order to file taxes. What do you need in order to actually file taxes? Make sure that you have all of your income. That is just a given. Now, this is where a lot of business owners get tripped up. If you're a business owner, and you did not receive let's say if you receive a 1099 as a business owner, just because you did not receive a 1099 does not mean that you do not need to file those taxes, that income on your taxes. One thing that I see over and over in 30-some years of doing this, I've seen people get audited, a business get audited because they left income out, and then they go to IRS during the audit and they say, well, this is all we received. IRS says, no, you received more than that unless there's a mistake. Because we received correspondence that you did receive this income from this organization or this entity. What that means, they took the deduction on their side because they paid the money out to the business owner, but they didn't give you a 1099, but they did file it with IRS because they want to get the deduction. So make sure you are responsible for all the income that you receive. You are responsible for that. If it comes in 1099, if you don't get a 1099, that's why you have to have, if you're a business owner, you should have bookkeeping services. You really should know all the income coming into your business and make sure that the income that's coming in, that what is tax exempt, there may be some monies that are coming in that you don't need to pay taxes on. If I, as a business owner, if I put money into my business, that is not income. What I'm doing is making an investment. I'm making an investment into my business, but it is not income. So you have to write that off. But I am going to go down a series of expenses that I want to note, so that we could have that discussion pretty quickly. Give me 1 second. All right, let's start with this. When you get your taxes done, make sure whoever is doing your taxes, let's start with this. Make sure they're very proficient in what they're doing. Most of the people who have audits, it's not even the person's fault. It is whoever prepared the taxes. When you're doing business taxes, it's not as simple as individual taxes. It's a lot to know about business taxes. If you miss one box that's not checked off, one box, let's say if you're have an S corporation or C corp, one box that is not checked off will actually cause your audit. So make sure that you have somebody very proficient. We're in the age right now of where you could do a lot of research online, Google, or whatever the situation is. Go to the Better Bureau Business Association and find out a little bit about that person. Also, Internal Revenue has a site that you could check professionals, whether accountants or tax professionals, to see what their accreditation is with the Internal Revenue Service. Again, most of the audits I see, it's not even, it's the business fault. It was because how that tax return was filed. Okay. Personal records. Make sure that you have everything on your personal side. If you got a partnership, what is the ownership percentages between you and another individual? Make sure all of that's in line. Make sure if you get your taxes done by another professional, make sure that you do take that last tax return, at least the last tax return, because there may be some carryover expenses that you could not have, that you couldn't take on that particular year, maybe depreciation, and it needs to roll over into the new tax year. So always make sure if you're going to a tax professional accountant that you take the last year tax return. Make sure that you have your current financial statements and your bookkeeping records. That's whether you're doing it in-house or if you are using a firm to do your bookkeeping for you. Every business owners, I don't care how small you are, you need to have some bookkeeping service. We're way past the point of spreadsheets. You need to invest in yourself. At least do something as simple as QuickBooks. But if your tax return, if you received in revenue over 250,000, the tax professional accountant has to send a balance sheet and other different financial information to the Internal Revenue Service, whether you know it or not. So make sure that you're doing good bookkeeping. We see some sloppy bookkeeping coming in here, and a lot of times people are missing a lot of different deductions because they've outgrown that mom and pop type structure. So make sure that you're doing some kind of in-house external bookkeeping to make sure that you're making sure that you're keeping good track of your records. If means if it's a situation where you get audited, our IRS is going to ask you for those financials. That's where they start. If you go in the IRS and the audit and you tell them you don't have financials, you're already on a slippery slope because you lost credibility with the Internal Revenue Service because of the fact they know that you don't have an organized system to track expenses and also income. Make sure you do that. As we talk about expenses, make sure that we have now so many people who have multiple businesses and those things. Good. Make sure you have proper structure. If you got business A and you have business B, business A and business B need to have their own bank accounts. The bank accounts is what's going to be one of the primary sources of your bookkeeping. You can't have business A and business B, and you're doing everything out of business A bank account. It's not going to work. So you need to be able to separate that. If you're serious about your business, put the time, put the effort, put the money into making sure that you have the proper structure. If you don't have the proper structure, that is the foundation of your business. Let me say this to you. I have seen people with the greatest, most inspiring business models, $1 million business model, multi-million-dollar business model, but have a $5 bookkeeping, record-keeping system. It does not make sense. So you make sure that you have these things together. It's not that I'm not going to be able to get on today. I'm just trying to tee out some larger items here. Make sure that if you're a business owner, I'm not going to get into the details of this because I will provide that information if you want it for later on, that you're doing estimated tax payments. If you're not doing estimated tax payments as a business owner, I'm telling you, if an audit hasn't happened, it will happen, because if you make a certain amount of money every year and that money has not been taxed throughout the year, then you're going to get some nasty letters. You do that a couple of times, then you're going to have an audit for the IRS, because that's what the IRS says. If that person's not doing this, that means they got all kind of stuff going on in-house regarding their taxes and things like that. Make sure that I'm just going, give me some, these are some general business expenses. I'm going to give a little information as I go forward, but these are some general business expenses. Number one, meals and entertainment. Real quick, I'm going down the line. Meals and entertainment. If you're a business owner, you should be writing up meals and entertainment. Well, leave entertainment off. They actually did away with entertainment for now. Okay, so it's actually business meals. You cannot no longer write off most of the stuff for entertainment. That was based in 2018. The tax law changed 2017-18. But meals, you get 50% of the meal deduction. You have to make sure that when you take the meal can't just be you. It has to be that you have gone to a meal with you, somebody else, whatever the situation is, and y'all are discussing business. You should note down every time you do that who you went to lunch or dinner with, had the meal with, breakfast, and what was the purpose of that bill. Was it marketing? Was it business acquisition meal, a meal, whatever the situation is? If you're traveling, make sure you keep up with everything: hotel, airfare, transportation, advertising, whatever, make sure these are things people just leave off. If you talk to legal, all your accounting fees should be written off. If you're paying to get your taxes done every year, you should be writing off of at least the tax preparation fees. Certainly if you're getting bookkeeping, payroll services, if you're getting audit, consultation service, all of that should be written off. Business insurance, taxes, business license, permit and fees, office supplies, internet and cell phone. Even if you use your cell phone, you need to adopt the cell phone into your business if you're using that cell phone as in relation to your business, and you need to pay for the cell phone out of your business account. All of these expenses will give you, if you come and there's an audit and you're paying it on the personal side, that means you commingled your account, and that deduction, although you're using it for your business, is no longer tax deductible. I've seen IRS, I'm telling you, I've seen many audits. I've seen IRS, somebody have all of these. We have an actor, just an actor, and he went through 2 years. When he came to me, came to us. He was coming from another accountant. They just did the taxes wrong. He got a 2-year audit, hundreds of thousands of dollars on the audit. Went through it and all this kind of stuff. As an entertainer, as an actor, there were some things that he could just take. Like you could do different things as an actor. Like you can write off different apparel. You can write off different haircuts and nails and stuff like that if it's done correctly. And what happened was, because he was using his personal account, because it was kind of connected to personal, they ruled those things out, and this is what they did. Anything that was in that personal account, I've seen them do this many times. They every expense on the personal side, they didn't give it to them because of the fact they have ruined the integrity of the expense. If we see on your bank account, your business bank account statement, that you're buying dog food from Petco, then they say, well, how do we know the Sam's? How do we know this Kroger is really business deduction? That's going to have a higher level of scrutiny in that audit. So just make sure you're doing that. Make sure that you're doing that. Bank fees, business loan expense. I see that a lot. A lot of people got loans around the COVID time, SBA loans, things of that nature. All those loans, any loan that you get for your business, it can be written off, the interest on that. Make sure that you take your home office deduction. Okay, now the home office deduction is normally only for a person, a business owner, who is not renting out office space. Normally, I've seen people lose in the audit with this, that they have their own office space, whether it's attorney or doctor or whatever the situation is. But because they work from home also at nighttime, they say, well, IRS normally will rule that out. I've seen it happen time and time again. So you are, though, if you don't have a quote unquote brick and mortar office space that you're renting out from month to month, you should be writing off an office expense, because if you're doing business out of the home, which most people are doing. All right, let's keep going. Vehicle deduction. This is a big one. This is a big one because of the fact you have to be using your vehicle. You have to be using it your vehicle in the course in the pursuit of your business. You ought to be using your vehicle. You can do one or two things with the vehicle deduction. You can either write off mileage or you can write off actual expense. That's the actual cost of the vehicle. That's the actual insurance you pay. That's the actual repairs and maintenance. You get the greater of the two. A lot of people do mileage. You get 70 cents a mile. That means if you drove 10,000 miles for your business, that's a $7,000 deduction. I like that deduction because that's not an out of pocket expense. It is, you had to pay for gas, of course, but that is a huge deduction. A lot of Uber drivers, a lot of people in the financial sector, advisors and stuff, going to see clients, a lot of those, those can add up. So make sure you're doing that. At lease payments, insurance, all those kind of different things. Of course, I'm not trying to get in the weeds or any of that, but you should be writing off. If you have a car, one car, you cannot write off 100% of the vehicle expense for that car because IRS says we are no fools. We understand that you got one car, you are using that same vehicle for personal travel. Now, if you get a second car, I tell my clients this a lot. If you're going to get a car, they'll call Malcolm, I'm going to get a car. What do you think? A, B, C, D, F, G. Okay, keep the car. Keep the other car. Don't just, most of the time, you're going to lose on the value anyway, trying to trade it in. But if you got a second car, now I can use that new vehicle 100% as a business write-off. Okay. And with these new accelerated 100% depreciation on the vehicle, you take it the first year. I mean, that is a huge windfall. You got to know what you're doing on these different things. Okay. So just want to help you understand that. If you're purchasing assets, doesn't matter if you go by a phone and you use your business for the phone, well, you ought to be writing that phone off on your business. If you're buying a computer, if you're buying an iPad, and the iPad is used in the business, you need to adopt that in the business, buy out the business account, and be able to write it off. Of course, you're buying vehicles, all those kind of different things are the same type of situation. Salaries you're paying. The salaries, this is a situation that sometimes get people, you got to understand, and I'm not trying to get into, the weeds on this as far as 1099s and W-2. Should a person be an employer or self-employed contractor, 1099 contractor, or should they be on W-2? There's a 7 to 10 point test IRS will take on that to verify if they are in fact a contractor and not a W-2 employee. Because if they're a contractor, that means you're not in control of their day. You're not paying for any of their supplies, their equipment they're using. You're not telling them how to perform their job because that's not how contractors do it. So it's a 7 to 10 point test. It just depends on how IRS does that to verify. So you need to make sure, though, any money that you're giving out, that you're writing it off. Now, if you're giving it cash, you get nothing here. If you're giving people cash, you do not get a write-off on that. Okay. Now I see this in the illegal immigrant space a lot, especially we do a lot of construction company. And I see that they use a lot of people who are not on paper. So what they do is give them cash because if they give them a check, they can't cash the check and they don't have a cash app, Zelle, things like that. So they give them cash. Sorry, but you can't get the write-off because it was cash in nature. It's not trackable. And IRS understands that person you gave the cash to is not going to write it off on their taxes. So make sure you understand that. I always tell business owners this. Hey, listen, either you're going to pay the tax on the money or they're going to pay it. Because if you can't write that off, that means you're paying taxes on the money that you gave them. So you need to understand that, okay? That may be a bargaining tool for how you pay them or how much you pay them. Where it says I'm paying your taxes approximately 25%. Well, I'm going to reduce what I'm paying you by 25% because I'm giving you cash. So you got to understand that as a business owner. I don't see people doing it a lot, but that is a bargaining tool that you can have when it comes to how much you're paying individuals that you're actually giving them cash. Make sure if you've got employer-sponsored plans, HSA plans, insurance plans, things of that nature, that also you're writing these things off. Charitable contributions. Yes, businesses can write off charity to a certain limit. We're not here to talk about the limits and all that today, but They can write it off to a certain limit. Okay. Okay. Let's see anything else around that. You can write off education expenses. But you have to make sure that you can add some of that, all of it back to your income. If you have a situation where you're paying employees daycare, dependent care, things of that nature, that's a write-off for the business, but also you have to charge that back as income to the individual that you have given it to. Uh, those are some of the budget items. I know I went through that very fast, but you just got to keep a mindset. Listen, if you're a business owner, keep a mindset. Every dollar you spend, you ask yourself, this is how you condition yourself and become very disciplined in the art of expenses, because this is where the rubber meets the road about how much you're going to be able to do as far as being creative with that business, as far as repositioning finances out of IRS hands back into your own hands. You got to ask yourself a question. If I'm going to Sam's, is this expense? Is it expense? Is it possibly, how can this be possibly a business expense? If I'm traveling, we're going to Montana, you're in the real estate business. Well, if you go in Montana, if it's business in nature, there's ways that you make that trip business in nature, and still you can also enjoy yourself in Montana. You need to be thinking along those lines, because people are spending a lot on traveling. So you have to understand, traveling everybody's traveling, but it has to be directly tied to your business, and you have to understand how to do that. But it has to be legit. Okay, no one here is going to wear orange suits. I don't think nobody on this call looks good in orange. Okay, so I'm just helping you out, because we're paying IRS, and you have administration. Regardless how you feel about the administration, I'm not here to talk politics. This is the most favorable tax administration, because this is administration for business owners. Okay, I'm not trying to make a political statement here at all. I have no dog in that fight. Okay, all politicians, I look at all of them one way anyway. So I don't have no dog in that fight. But I'm telling you right now, things have opened up splendidly with this new tax bill. Everything I just told you today, though, is pretty much old. If you have an accountant, these are things they should be asking you. If you have a tax professional, these are things they should be asking you. And so keep doing what you're doing, going to who you are, or going to, and all those kind of things. This is not about us trying to market our services. I just want the people to be equipped, because I see too many years how people come in here and I say, man, it's time to give people literacy about what they should be doing. Understanding business tax deadlines. Okay, business tax deadlines are set based on your tax structure. Okay, so sole proprietorships, that's like a Schedule C. The tax deadline is going to be April 15th, the same day, the same tax deadline that your personal taxes are due, because they're part of your personal taxes filed on the Schedule C. If you're S corporation, this date is coming up very soon. If you're S-Corp or a partnership files Form 1065, S-Corp file 1120Ss. Your deadline is March 15th, unless that March 15th falls on a weekend or holiday. Then it takes the next business day. Remember, with all business structures, you do have the opportunity to file an extension. Okay, it's an automatic extension. So remember that. Now, let me say this. If monies is due, it doesn't matter if it's business or personal, you file an extension. They're just giving you an extended time to file the taxes. It is not giving you an extended time to make the payments. They still want their payments. So if I file an extension March 15th on the S-Corp, S-Corps don't pay no taxes, okay? Their taxes, their income or deductions to flow through to the personal. So that says a C-Corp. It has to be filed April 15th. C-Corps are filed April 16th. April 15th. And the C-Corp owed $20,000. You don't get an extension on that. that money has to be sent in there. If it's not, you're still going to get penalties and interest, because I already said if you'd have gave it to us on the time that you're supposed to give it to us, we could have been drawing interest on the money because it's our money. So they're going to give you penalties and interest whenever you pay the money. Okay, very good. All right, so that's what I have today on deductions. So I got some more information. I really want you to hear this today, so we can kind of just help you position yourself. Some of you are probably going to be filing taxes in the next week or two. I was supposed to have this a couple of weeks ago. We've been getting slammed on a lot of different fronts as far as clients and their needs and new clients. So we had to unfortunately put it up for 2 weeks. But if you have a S-Corp, a partnership, and you're not ready to file by March 15th, then make sure, absolutely sure, that you tell whoever to file you an extension electronically. Don't do it mail no more. Mail doesn't work because IRS doesn't, it works, but they're so back on mail right now. It's no longer, and so you know this. It used to be that if your tax return or payment was postmarked on a certain day, IRS gave you credit. They don't do that any longer because the post office came out earlier this year. If you've seen the news, they came out and said we don't back that claim anymore, because if you drop your mail off on March 15th, April 15th, we can't even guarantee it's going to leave our facility on that day. So we no longer guarantee postmark date. So IRS says, okay, since our post office doesn't respect that any longer, then we can't go to the taxpayer if it's postmarked. So make sure you understand that. Everything I like to do it electronically. Some things you just can't do electronic, but everything. Make sure if you got a business, if you got something that you're passionate about and you're making income, I love that, because that's what a good business owner is. I'm passionate about something. I'm going to turn it around to a profit. I'm gonna maximize and make my passion my profit. Oh, I love that. Now, make sure you're not so passionate about it that you forget about it. Needs to really be a business, because if you start writing up deductions, our IRS is trying to see if it's actually a business or a hobby. Okay, so let's talk about that. You cannot just have a pie in the sky dream and you really don't have an intent to make it a real legitimate business, make income. You can't do that and just start writing off stuff just to make your taxes look favorable with all these write-offs. IRS will normally after three out of 5 years will normally accept the loss. Okay, will normally accept the loss. Then they start looking at the return to make sure, is this thing really a business? They've been writing off $1,000 a year in profit or sales, but they're writing off $9,000 in expense, and they've done that for 3 years. It doesn't pass the smell test with IRS. You're gonna get a letter, especially now, because what happens now, most of these are not random returns. They're not even random returns. What they are, when these returns go into the system, IRS database and system, they got algorithms, and they're matching the different line items and comparing that from year to year. So a lot of times people say, well, how did you pull my name? IRS will tell you, we didn't even pull your name. The system is doing this work. So you have to be very careful with that. If it's a hobby, you can't write it off as a business and take the deductions. If it's a business, treat it like a business. Whoever is your profession, they can tell you how to legally do that and make sure. Now, if it's certain businesses, there are certain businesses that takes a lot of money up front to operate the business, got a lot of upfront startup costs. It may take them 7 years to get into the profit. It may take them 7 years. That's okay with IRS, because they're going to look at that business. They're going to look at if the income is increasing from year to year. Also, that accountant should be making notes on your tax return. Notes are very big on the tax return. It is significant, because before you get an audit, IRS, the first thing they're going to do is look for what we call preparer notes. If the notes make sense, reason people get audits because IRS says, we don't understand this. We need you to come in and help. This needs to make sense to us. So we bring you in so you can help us make sense out of this situation you got here. But if I got good preparer notes, guess what? They're going to read that first. Oh, got it. Oh, they're a real estate agent. they own real estate. They're writing off their properties on a Schedule E. They're using the Schedule C to write off their mileage, but they're really in business, and we don't see the income on the Schedule C, which is the sole proprietorship form. The income is on the Schedule E. Now we're able to link those two together and understand the narrative. Preparer notes will save 90% audits if they were used. That's why they're on every tax return. They're built into every tax software system. You have to use notes. Make sure that they're not lazy and that overlooking that. I'm giving you stuff so you can remind them and say, hey, this how I was on a seminar. Can you put this in there as notes? Yeah, we'll put it in there. Make sure when they give you a copy, you see the notes. Okay. For business expenses, real quick, business expenses. All business expenses have to be what we call normal and ordinary. They have to meet those two criteria. A normal, I'm on the accounting side, okay? As an accountant, it's gonna be hard to prove to IRS. Let's say I did $20,000, 20,000 miles. 20,000 miles, which is going to come up to about $14,000 as a deduction, because it's 70 cents per mile. They're going to say, hold on, he's an accountant. What kind of traveling could he be doing for 20,000 miles a year? Now, mileage for an accountant is normal. I got clients that we go, I don't let them, we got different clients who don't want anybody to see them. They may be in the entertainment space. They may be a professional athlete. They don't want to come to the office. You need to come to me. I need to see you face to face. We need to talk. Well, that's part of the business model. Let's go. It's a normal expense for an accountant, but it has to be normal and ordinary. Is it ordinary? It's normal that he writes off mileage, an accountant, him or her, but was it ordinary? But is it normally do they write off $20,000 unless they got some kind of special situation going on that can be backed up by notes and it makes sense to internal revenue. So every expense has to be normal and it has to be ordinary based on that industry that they're in. Truck drivers who own the road normally don't get business meals expenses of taking people to lunch to discuss scaling up their business. They can go to a consultant. Now, what they can do is write off their expenses, the meals while they're on the road. That's normal and ordinary now. Okay, so you have to understand, does it meet the normal and ordinary when they look at a deduction? Is that normal and ordinary for what they're doing? Is it excessive? If it's excessive, we need to have a conversation. We may let it ride 1 year, but we see the same thing. Make sure, please do this. Do not let people, and don't you try to do it, write off deductions in round estimated numbers. That is a flag. Every year you can't have advertising at $5,000 to the T. Come on, you can't do it. It ain't gonna pass the smell test IRS. I mean, it ain't no sense. I mean, every year is 5,000, 3,000, 8,000. No, they're not gonna give you that. They look for those situations, so you got to stay away from that. They're telling them that people are just taking numbers and estimating. They're not even knowing what they're doing. They're just estimating and putting stuff down. Or they're accountant, tax professional, and that's all. I've been doing this for 30-some years. I've seen so many people get audited, and I just wanted to tell them, hey, all this individual had to do was simple stuff. Okay, so make sure that. Also, talking about business expenses, I told you a lot of the different business expenses, but talking about business expenses real quick. Give me 1 second. I want to change screen needs to change, I think. Give me 1 second. Okay, here we go. Yeah, normal and ordinary. Business startup expenses. When you have a business and you did a lot of startup, expenses. You may have did a lot of advertising. You may have done a lot of different things to start you in business, purchase inventories, things of that nature, did leasehold improvements, renovations on a build. You cannot take all of those expenses in 1 year. You have to do what we call amortize them. You have to spread them out over 15 years. Because I already said, if you take all of your expenses in 1 year, you got a business the second year, and you didn't took all that's not what the purpose of expense was. Now we do have something called Section 179, where we can accelerate a lot of those expenses, but it has to be done right. Okay. But also always understand that. And then you got somebody tell what kind of consult you and tell you this. You don't want to write them off most of the time you shouldn't want to write all of them off anyway, because a normal business is going to have more income from year to year. And if you use all of your startup expenses the first year, you don't have anything left in the remaining years outside of operating expense to offset the income to bring the income down. Let's talk about some audit triggers. Income discrepancies.
It's something about taxes. But it's
your income does not reflect. We're supposed to have this on mute. I apologize. You're speaking. We're supposed to have that on mute. Please put your computer on mute, if you will. So I appreciate you so much for being on. Just make sure that you put that on mute, please. Let's see here. Audit triggers. Let's talk about audit triggers. Audits. Income discrepancies. You reported something and they got more income information, and maybe from a credit card vendor, maybe from PayPal, maybe from Cash Out, maybe from Zelle. They got more that the Biden administration, the last administration kind of started that, and well, it already existed, but they put a little more structure around it. So make sure that high volume cash transactions, when there's a lot of cash going on in the business, especially such as dry cleaners, salons, restaurants, that's an audit trigger. Excessive deductions, I already talked about that. If you got excessive deductions and it does not look proportionate to the income, this is what that means. A person wrote off $500 in income. They didn't write it off, but they reported a $500 in income, and they have a let's say they have a lawn care service. So I made $500 for the year, but on your tax return you wrote off $30,000 in mileage. It's excessive. Who all did you go to for 30,000 miles? You only made $500. So how that doesn't, that's an audit. That's an excessive expense, excessive deduction. Consistent losses, I already talked to you about that. Hey, this stuff I'm telling you is stuff that are very common. I see it year to year. I see it year to year. Worker misclassification, I already talked to you about that. Independent contractors doing 1099s on so many different people, not W-2. That's an issue, because when there's a check, when they check the system and you did a contractor and something flagged the system, that's going to be an issue. Make sure if you're the owner of the business and you're doing S-Corp, if you're doing S-Corp, that's just the only one, and maybe even C-Corp, make sure that the owner is taking a reasonable compensation, or make sure they have to be on payroll. They just cannot pay themselves out of a checking account. It has to be on payroll. My company here, most of our companies is an S-Corp. I pay myself on W-2. I'm gonna tell you, I don't even get the money. I just need to make sure I'm compliant. I don't even, if I'm paying myself $2,000 a week, because I got a couple other different ventures going on as well. I mean, I need the money from that. I got to pay taxes on it though, because I'm building something. Okay, give me 1 second. Okay, good, I got it. Okay, let's see. Make sure that you're not writing up all your income every year. The name of the game is not paying less taxes, is growing yourself, scaling yourself. And if you go to the bank and you're writing off all these expenses, you're going to have a hard time at the bank trying to acquire different assets and really do special things. The economy is about to do possibly some flipping on some things. You're going to see businesses, buildings, they're going to be reduced. You're going to see a lot of different opportunities. And you go to the bank with these tax returns, these business tax returns, and you done wrote off everything. You're not going to be able to be in a good opportunity to be able to maximize that opportunity. So you need to know it needs to be a balance there, okay? I would rather pay IRS their due and be able to increase wealth because I'm able to go out and buy things. I'm able to go out and purchase things. I'm able to go out and do these different things. And that's where my net worth is really going to grow, not just, saving a few dollars on my taxes, although you need to save money on your taxes. Separate personal from business. I already told you that. All right, we're coming down to the end. I hope this is helping somebody, but tax planning versus tax preparation. Mostly, for the most part, tax preparation is almost dead. People don't even market tax prep because that's not what the big thing. The big thing is tax planning now. Planning, which means you have to have foresight. What are you trying to do? What are your goals? What are you trying to do? And then we're using different things in tax planning, like using your retirement. Hey, I got to pay IRS all this money now. Well, won't you create a retirement plan within your company, grow money, not give it to IRS, it's still your money, but you're growing it now for retirement purpose, things like that. Hiring family members, hiring your children, whoever your tax professional accountant is, they can walk you through that. If my child I can pay my child almost $16,000 a year, and they don't even have to file taxes on it because they're up under the income threshold to file a tax, and I still get the deduction on my side. Okay, correct salary from your business. If you're taking the W-2, is the W-2 compensation you're receiving, is it correct? Because if you're paying yourself too much, you're going to be paying out too much tax. If it's too less, you can still be paying too much in taxes because you're not able to offset some of the profit on the other side with a W-2. Real estate, putting real estate a part of your perspective. All of this is tax planning. You need to start running strategies now. Timing of income. Having a client. I just told a client the other day, I said, listen, you have an opportunity. You had a very high income year. It was significantly high, good for you. But before these vendors or these people you're working for, these people, you got these contracts from these different companies. Tell some of this toward the end of the year. Tell them, hold off on paying it this year. I already got high income, very high, because I've had a couple spikes in income. I may not see it next year. Tell them to hold the income until next year so that I can file that tax. That's a timing situation. I'm still reducing my taxes. Make sure you understand tax credits. Everything is not just deduction. Something is tax credits. Do you know that right now the federal government has said they're doing away with things such as SNAP, which is food stamps, so they're reducing it. And what they're trying to do now is get the people to work. Do you know you can get up to $9,600 as a credit? Hiring people who had SNAP or own SNAP, hiring people who has a certain type of criminal charge with the prison. They want those people to start working, not hiding under the system. Veterans, disability people. A lot of people don't know about that. They don't know about these are credits that are out there that some of us should have been already taken, but you got to know how to now merge that in. You got to know how to merge that into your hiring practices now. If I hire this person, they may be, everything may be equal. I think they both can do a good job. Hire the person that's going to give you a work opportunity credit because of the fact, if I can get $9,600 toward my taxes, here it is now. It makes more sense to hire that individual. So the government is giving you an incentive to hire some of these classification of people. And they said, because you've done that, because you're partnering with us, what we're going to do is give you up to $9,600 for helping us out. That's amazing. All these returns that I see, people are not thinking of these things. Also, things such as the disability access credit, which means if you're opening a restaurant, you're opening an office space. Do you know if you're making your business, your building, have certain things on the disability code as far as the setup of the facility, you get a credit because you are helping disability people be able to come to work in your space, or customers. They will actually give you a credit for that. So these are credits. Listen, my time is far spent, but I hope you're hearing what I'm saying, because you have an opportunity to reposition money out of the IRS hands. You work for the money. You're on the road, you're grinding it out every week. And it's just unfair to give them, and they don't listen. The whole law was written for the business owners. They want you to write off these things, but it has to be done correctly. So let me, instead of giving IRS 35 to 30, 40 to 25% of my income that I'm making, let me reposition the funds. That's what tax planning is all about. If you're making over $50,000, especially $100,000, you should really be talking to someone about tax planning. So you can't get mad at your accountant or tax professional because they didn't ask you these questions, because what you've been doing is getting tax preparation. That's not their job to get into the weeds of all of these different strategies. It's their job now to create a financial plan for you, tax planning, and be able to do these different things. It's just like a finance plan, but it's a tax plan that gives you what you need at the beginning of the year and during the year to make sure that you and it's worth it. Trust me. Okay. I think that's it. Now I'm going to take a few questions, and I will get a disclaimer. I will not go into the weeds. Okay, I'm not. I will answer questions in general, but I don't want to take time to answer something that's kind of a little bit extensive, going to have because I'm liable for that information, and so it may be out the wrong context. One size don't fit all type situations. So if you had comments, this is a good time to ask your question, and please feel free to do so. Is it too late? Okay, Julie, I see you. Is it too late to move the accounts? I have 3 accounts, but also have personal income spread across the account. Oh, thank you for that. No, it's not. It's never too late. Let me tell you, there is something that IRS you will not find in any tax code. IRS almost flow like the Bible. The Bible has a word in it called mercy. IRS gives you credit for the most part if you do it right now. And if they ding you on last year or the year before, you say, but it's right now. I just didn't have to understand. I didn't have the proper professional consultation. Many times that agent will give you a pass on it. They'll give you a pass. When I talk to you about that actor, the actor I told you about owed hundreds of $1,000s. Can I tell you this? By the time we finished and went to the different agents we, represent, do you know they gave him every deduction? Every deduction, he's still a client today. Every deduction they gave him, even though it was in a personal account, because we made a very, very appealing case of mercy. He did not know. We're sorry for that. We had different things that we had written up, gave it to him. The agent, it exceeded my expectation. I was in the background saying, what? You give what? Glory. So it's never too late. Just make sure it happens. Let's go to the next one. Realtor, how much of my commission should I set aside for tax? Traditionally, we tell people that is a loaded question. But let's say if you don't have children, because you have children and some other things going on, it may be lower. But we say just to build on the safe side, be conservative. Do at least 30%. That's federal and state. Do at least 30%. Some say about 35%, but at least 30%. Again, if you have other things going on, if you got credits out there, you got children, you got a college out there, some of the things, maybe some energy efficient home credits, windows, doors, and all these kind of different things, roof installation, it's itemizing. So at least do 30%. I think you should be safe. Even if you have to owe money from that, it won't be too much. This has been so insightful. It's a serious thing. Thank you, Lakeisha. Relative to how much of my commission, I just went through that. Is there a tax benefit of creating an S corporation to own my LLC? Okay, so the S corp. Let me clear something up. The S corporation does not own the LLC. I don't have time to dig. The next one will deal with business structures and how we leverage the different business structures to benefit you on the tax side. But Lakeisha, because you did comment and say, this has been so insightful, I just feel led to answer your question about the S-Corp, okay? There is a tax benefit most of the time for paying S-Corp, creating an S-Corp, okay? Creating an S-Corp is very big. It's very big because of the fact that the S-Corp doesn't pay taxes. The income, the profit rolls into the personal tax return at normally many times at a much lower tax rate. And so you can save thousands of dollars even in the first year of doing that. Now, let me say this to you. The S-Corp doesn't, or the LLC doesn't own one another. It's just the S-Corp is called a tax classification. So if you're LLC, which most people are, I love it. You're the right structure, keep it, okay? LLC. But LLCs, I'm just going to give you a little bit of information real quick. LLCs could be taxed many different ways. It could be taxed as a sole proprietorship, which is the most simplest form. You file that with your personal tax on the Schedule C. It could be taxed as an S-Corp. It could be taxed as a C-Corp. You could tax it as a partnership, okay? So this is the thing. Once you get your organization structured, you're not cannot just claim that up front. You have to go through a process to get that approved through the Internal Revenue Service S-Corp. Then you can do that. So S-Corps are very favorable. 9 times out of 10, I ask, somebody's going to ask you qualifying questions to make sure it will benefit you. 9 times out of 10, I said benefiting people. Again, most of our businesses are S corporations. Okay, there's a reason for that. You get a lot more flexibility on the deduction side. You get a lot more opportunities to do tax strategizing through that S corporation. You can do it on a personal too, but it's not as easy. And a lot of stuff is so sophisticated that really that tax return, that small tax return, is not set up. That Schedule C is not set up to run those kind of strategies on it. And you may get audited very easily, even though it's right, because IRS just don't understand why you're using this form to run all these sophisticated strategies. So S Corp normally is going to be very favorable for you. So now, in my next session, I'm gonna give another session here. You can call for consultation on it. I'm gonna give some more general discussions on tax strategies and what makes you want to be this and why you should be this from a tax perspective. Okay, I'm gonna bring the legal part to it, but I'm gonna be safe. I'm not gonna go outside of my wheelhouse. We got excellent attorneys who do that, but I'm gonna normally answer from a tax perspective, but I can give some general legal just as long as it keeps me safe. Okay, let's see here. Oh, wow. Thank you, Dr. Tony. I see you. Thank all of you all for saying thank you. Brian, you mentioned some of y'all have been clients. I got some clients on here. Y'all been clients for over 25, almost 30 years. This is one Brian Lewis. Also, they got real estate companies, real estate holdings, limousine services. They're doing great. These are clients that really, they hear what we tell them and they go out, they're maximizing him and his wife. But you mentioned roof installation. You mean to tell me I could have written off my roof as not the roof install. So, okay, that's good. So when it's a home office expense, you can get part of the repairs on that. But the roof installation, you really need, you get a bigger deduction as a energy efficient credit. So every year I go back to my clients and I make sure that at least I ask them that question, that the roof installation. And if you didn't do it, you can go back and do an amendment if it makes sense. Now, let me tell you if it makes sense. If your roof costs $15,000 and you you had to pay $1,000 because that's your deductible, insurance company, that means you're only dealing with $1,000. That's gonna have, but if you pay for the whole roof, which is kind of uncommon for a lot of things right now, you can take the whole thing and you'll get a certain percent. You can get up to $1,200 on that credit for that, and it has some limitations to it. But Brian, if you want to talk about that some more, let me know, please. All right, thank y'all for coming. Hey, time is far spent. Look, I got some QR codes over here, and I'm telling you, we're gonna be building this platform. I want the people to be informed. If people on this who knows me, they know that to me, everything ain't just about $1. I got to have the people informed, because if you inform, you have equipped and empowered yourself to do great things. If you want to book an appointment, there's a QR code over there. I can do a small consultation with you. Facebook, please check us out on Facebook. We're putting all kind of live information. I just talked to our marketing people who are also on our platform too. We got marketing agents in here. We just agreed how we're going to be putting information on there every day, every 2 days, Instagram, and visit us at our website, bestwaytax.com. Listen, my time is far spent. I definitely speak blessings on everybody, your companies. We're truly in some turbulent waters right now. You have the best thing, maximize that business in this age of foreseeing AI and all that kind of stuff. You really need to have these streams of income coming in. If you're working, that's fine, but hey, it's time now to really grow these business scale up like you need to scale. It's not just about making money, but it's about scaling up. Second, scaling up when you get the money coming in, reposition the money back to yourself, and tell the IRS, we thank you for what you do. We're going to give you your portion, but a big portion of this belongs to me, my family, and my legacy. Thank y'all. If we do anything to help anybody, let us know. March 15th coming up for S Corporation and Partnerships. If you haven't filed your taxes, make sure you reach out to your people. Tell them to put you an extension in there well before March 15th. Thank y'all so much again. We'll be coming back to you live at some point, and may God bless each one of you. Thank you for joining today. We appreciate you and we value each one of you. Thank you.